Hi there, I'm Erik Cooper from ArcVest. Today, I want to talk a little bit about investment rules and why your investment rules matter more than your market insights. I know you think this is counterintuitive, but let me start with something we don't often hear enough about in investing. Your long term success probably won't come from having the best market insights. It just won't. It will come from having clear investment rules and following them consistently. That might sound counterintuitive. After all, investing feels like it should reward people who are smart, informed, and quick to react, maybe like a hedge fund. But in practice, outcomes are driven much more by process than prediction. Financial media is built to pull you in. A confident analyst lays out a clean story. This sector is about to take off. A recession was right around the corner. Now is a time to get defensive. We've heard all the lines before. The charts look convincing. The logic sounds tight. And it creates this powerful urge to do something with your portfolio. But for most investors, that urge is exactly the problem. Why being right isn't the same as being successful. We love stories of market brilliance. The investor who saw 2008 coming, the early believer in a breakthrough technology, the manager who called the top. These stories are compelling and misleading. They create the impression that wealth is built by superior forecasting. But when you zoom out, successful investing is usually less about prediction and more about avoiding avoidable mistakes. You want to be staying invested, managing risk intentionally, and behaving consistently through uncomfortable markets. That's where the rules come in. So we have an insight trap in investing. Insight driven investing creates a few predictable problems. First is overtrading. We get new information or new opinions presented as information, and it encourages frequent trading. That increases taxes, transaction costs, and the odds of bad timing. Second, we find emotion dressed up as analysis. When a prediction works, confidence grows. When it fails, investors often double down, panic, or abandon the plan entirely. Third, there's strategy hopping. A well designed approach gets replaced by the latest narrative, usually after it's already worked for somebody else. And finally, we run into concentration risk. High conviction bets feel sophisticated, but they raise the stakes dramatically, especially when they're not part of a broader plan. There's also a structural reality here. Markets digest widely available information quickly. That doesn't mean markets are always right, but it does mean headlines and forecasts rarely translate into a durable edge. So, why do rules usually win? Well, a rules based approach doesn't mean your portfolio is an autopilot forever. It doesn't mean judgment doesn't matter. What it means is your default decisions, the ones that drive long term results, are pre committed, repeatable, and align with your goals. And that's a big deal. Rules reduce emotional decision making. Market declines trigger real stress. Market rallies trigger fear of missing out. In both cases, the most tempting action often feels the most damaging. Selling after a drop, buying after a run up. Rules change the question. Instead of asking, what do I think happens next? You ask, what does my plan require? That shift alone can prevent some of the most costly mistakes investors make. Rules create consistency, and consistency compounds. Many strong outcomes come from unglamorous behaviors repeated for years. What are these behaviors? Contributing at regular intervals, maintaining diversification, and rebalancing when needed. None of that relies on being right about the next quarter. It relies on showing up. Consistency doesn't make headlines, but it compounds. So, we need rules to protect from overconfidence. Overconfidence is one of the most documented behavioral biases in finances. After a few wins, it's easy to believe you're better at timing decisions than you really are. Rules act as guardrails. They limit how much damage a short term conviction can do to long term plans. what good investment rules actually look like. Good rules are specific, measurable, and realistic. They're designed to be followed during stressful markets, not just calm ones. There are four categories that tend to matter most. Asset allocation rules, or defining risk on purpose. Your asset allocation, how much you hold in stocks, bonds, cash, etc., is the backbone of your investment experience. It determines how volatile your portfolio feels and what range of outcomes is realistic. A simple rule might sound like maintain a 70-30 stock bond mix until 10 years from retirement, then gradually reduce risk. Decades of research show that asset allocation explains a large portion of a portfolio's return variability over time. Translation: getting allocation roughly right matters far more than chasing the perfect predictions. Rebalancing rules, or controlling drift. Over time, winners grow and losers shrink. Without rebalancing, your portfolio slowly becomes something you might not have intended. Common rules might include rebalancing annually or every 2 years, or rebalancing when an asset class drifts more than 5 percentage points, or using some hybrid of each of these. Rebalancing creates a disciplined way to buy lower and trim higher without trying to call tops and bottoms. Contribution rules, staying invested through all markets. Regular contributions removes the pressure to pick the perfect moment. This is often called dollar cost averaging. And while it doesn't guarantee a profit or prevent losses, it helps investors stay consistent. Simple rules might include investing a fixed amount every paycheck, or increasing contributions by 1% each year until hitting a target savings rate. The real benefit is behavioral, not mathematical. So you need to review your rules and stay aligned without constant tinkering. A good rule of thumb is review enough to stay aligned, not so often that you react. Few examples. Review your full financial plan annually. Review investments quarterly at most. Do not make changes based on headlines. Too much monitoring invites unnecessary actions. These rules will work best inside a full financial plan. Investment rules don't exist in isolation. They should reflect your broader financial reality. So your retirement timeline, taxes and account types, estate planning, your social security strategy, and your health and insurance planning. The same rule can be appropriate for one person and risky for another. Someone still accumulating assets can tolerate more volatility than someone newly retired and drawing income. This is also where a fiduciary advisor could add real value, not by predicting markets, but by translating goals into a workable system and providing behavioral support when markets get uncomfortable. The discipline dividend. Rules-based investing doesn't feel heroic. It's quiet. Most of the benefits are invisible in the moment. But over decades, avoiding a handful of common mistakes can materially change your outcomes. Not panic selling, not chasing recent winners, not letting your risk drift too far away from your stated goals, and then not reacting to new persuasive narratives. The edge isn't brilliance, it's reducing self-inflicted damage. So how do we put this into practice? If you want to move from insight-driven decisions to rule decisions, start simple. First, write a one-page investment policy statement. Include goals, time horizon, allocation, rebalancing rules, and what would justify a change. Second, turn these principles into triggers. Replace vague intentions with specific actions. Third, decide how you'll behave in a downturn. Write down what you'll do if the markets fall 10, 20, or 30%. And fourth, add accountability, an advisor, a spouse, or even a cooling off period before making any huge changes. And finally, update rules only for life changes, not market noise. The bottom line is this: markets will always tempt you to react. Predictions will always sound compelling. But most investors don't need more insight. They need better systems. The goal isn't to be the most clever investor in the room. It's to be the most consistent. And consistency is built on rules. I'm Erik at ArcVest, If we can be helpful, please reach out.